Did you know that real estate syndication accounts for over $10 billion in transactions annually? This staggering figure highlights the immense potential in the sector, especially for general partners. Today, we're going to explain tax benefits in real estate syndication from the general partner's perspective, unraveling how you can capitalize on these opportunities. Let's get started. What is real estate syndication? Real estate syndication is a partnership where multiple investors pool their resources to invest in property ventures. It's like joining forces to buy and manage properties that would be financially out of reach for an individual investor. Consider a scenario where a group of investors collectively raises $2 million to invest in a $10 million commercial real estate project. Each investor contributes a portion, making them part owners of a significant property investment. Tax deductions. Specific to general partners. Tax deductions specific to general partners in real estate syndication refer to the expenses that can be legally deducted from their taxable income. These deductions are integral to the financial management of real estate investments and can include costs like mortgage interest, property taxes, operating expenses, and depreciation. In real estate syndication, general partners are responsible for managing the investment, which includes optimizing tax strategies. Utilizing these tax deductions effectively can significantly reduce the taxable income for the syndicate, thereby increasing the overall return on investment. Imagine a syndicate property generates $500,000 in rental income annually, but incurs $300,000 in deductible expenses, like mortgage interest, maintenance, and property taxes. The taxable income is reduced to $200,000. This reduction in taxable income can significantly impact the net profit and investors' returns. Depreciation benefits. Depreciation is like an accounting trick where you pretend the value of a property goes down each year due to wear and tear, even though its market value might actually go up. This loss in value can be subtracted from your income when you calculate taxes, which means you pay less tax. In real estate syndication, depreciation is a key tool. General partners use it to reduce the group's taxable income. This means that although the property may be earning money, on paper it looks like it's losing value each year, which can lead to paying less tax. Let's say a syndicate buys a building for $1 million. The IRS might say this building will wear out over 27.5 years, which is a common time frame for residential properties. So each year you can claim about $36,364, $1 million divided by 27.5 years, as a loss due to depreciation. If your property made $100,000 in rent that year, you can subtract the $36,364 from this amount, and now you only pay tax on $63,636 instead of the full $100,000. Capital gains. Capital gains are the profits you make when you sell a property for more than you bought it for. It's like buying a toy for $5 and selling it later for $10. The extra $5 you get is your capital gain. In real estate syndication, capital gains are important because they represent one of the main ways investors make money. When the group of investors, the syndicate, sells a property for more than the purchase price, the profit made is split among them, according to their investment share. Imagine the syndicate buys a building for $1 million. After a few years, they sell it for $1.5 million. The sale price is $500,000 more than the purchase price. This $500,000 is the capital gain. If you, as an investor, own 10% of the syndicate, you would get 10% of this $500,000 profit, which is $50,000. That's your share of the capital gain from this investment. 1031. Exchange. A 1031 exchange is a tax strategy in real estate where you can sell a property and then use the proceeds to buy a new one without immediately paying taxes on the profit. It's like swapping one toy for another without having to give away some of your candy as tax. In real estate syndication, a 1031 exchange is a clever tactic. When the group, syndicate, sells a property, they can use this rule to purchase another property without paying taxes right away on the profit they made. This allows the syndicate to reinvest more money into new properties, aiding the growth of everyone's investment. For example, Suppose your syndicate sells a property for $1 million, which originally cost $700,000. Normally, you'd pay taxes on the $300,000 gain. However, with a 1031 exchange, instead of paying taxes now, the syndicate uses the entire $1 million to buy a new property. This means you're investing more money into the new property than you would have if taxes were paid first. Pass-through. Deductions and business expense benefits. Pass-through. Deductions and business expense benefits are like special discounts on your taxes. If you're part of a real estate syndication, you can lower your taxable income by subtracting certain costs of running the property, like repairs or management fees. It's like if you earned $100 but spent $20 on expenses, you'd only be taxed on $80. In real estate syndication, these deductions play a significant role. They help reduce the amount of money the syndicate reports as income. Less reported income means lower taxes. This is beneficial for investors because it results in more profit remaining after taxes. Imagine your syndicate earns $500,000 in rent in a year, but spends $200,000 on expenses like property maintenance, management, and other costs. Instead of paying tax on the full $500,000, the syndicate only pays tax on $300,000, $500,000 minus $200,000. So as an investor, you get a larger share of the profits because less money goes to taxes. Tax credits and incentives. Tax credits and incentives are like special coupons from the government that reduce the amount of tax you have to pay. They're different from deductions because they directly lower your tax bill, dollar for dollar. If you get a $1,000 tax credit, you pay $1,000 less in taxes. In real estate syndication, these tax credits and incentives can be really valuable. They can come from investing in certain types of properties or for making eco-friendly improvements. For the syndicate, it means they can save a lot of money on taxes, which increases the profit for everyone involved. Let's say your syndicate spends $100,000 on making a building more energy efficient. The government offers a tax credit of 10% for these kinds of improvements. So, your syndicate would get a $10,000 tax credit. If the syndicate owed $50,000 in taxes for the year, this credit would reduce the bill to $40,000. This means more profits to share among the investors. As we wrap up, understanding and strategically using these tax benefits can significantly enhance the profitability of real estate syndications. For general partners, it's not just about finding the right properties to invest in, but also about optimizing these tax strategies to maximize returns for themselves and their investors. Remember, a well-informed tax strategy is a powerful tool in the real estate investment arsenal. Here is a gift for you. We offer a free consultation with our expert tax professionals. To book your free session and gain valuable insights tailored to your situation, simply click the link in the video description. Don't miss this opportunity for expert guidance. If you found this information helpful, please show your support by liking, subscribing, and sharing this video. Your engagement helps us reach and assist more people. Don't forget to drop your thoughts and questions in the comments below. We love hearing from you.